Thanks everyone for joining. I know we are slightly light on the panel today. I think people are being decentralized and living where they are in the world. But I think we still have a pretty awesome lineup of investors and DeFi founders with us. So excited for the conversation. I feel like people don't need any introductions, but maybe for the sake of the audience, do you guys mind telling us a little bit about yourselves and your projects?
Yeah, sure. I can go first.
Oh.
Check 1, 2, check, check. There we go. Yeah, so I'm Kain, Warwick, founder of Synthetix, and most recently founder of Infinex. So we are one of the OG derivatives protocols in the space, and yeah, been building in DeFi for a little while now.
Hi. Wow, it's like 10 times louder than yours. I'm Jordi Alexander. I'm the chief alchemist at Mantle. Mantle is a modular layer 2 on top of Ethereum. We just launched very recently and focusing very much on DeFi.
Hey everyone, I'm Rune Christensen. I'm the co-founder of MakerDAO, which is the DAO behind the world's largest decentralized stablecoin. And what we're currently doing is we're splitting up the project into many sub-DAOs, which is what I'm all about.
I think one thing that I was thinking about with this panel is I feel like going through a few cycles in crypto, you sort of see ideas rise, you see ideas fall, but you sort of gain experience every time. And I think everyone on this panel has been in this space for a while. And I think in particular, been in DeFi for a while, even before like the term DeFi was sort of coined. And so for you guys, having sort of been through sort of the pre-2020 cycle going into now, what do you sort of take as a big lesson from the 2020 cycle? Like, what were your biggest learnings? What were your biggest surprises? How do you sort of think about the experience that you've gained?
So I think one thing that was pretty interesting about the last cycle was how it kind of got out of sync. So unless you're DGen Spartan, in which case I think it was in sync for him. But we had this kind of DeFi boom that happened much earlier than the rest of the market sort of responded. And that kind of, I think catalyzed a lot of interest in the space. And then later on the L1 kind of explosion sort of, I think, put a little bit of pressure on DeFi to try and keep up and retain interest. And so, we had DeFi 2.0 emerge, and there were some novel things that happened. But throughout that entire time, the OG DeFi projects just kept building, regardless of the attention that was sort of being paid to a lot of our projects. We just kept building and, kept scaling and kind of making things work. And we got to a point where I think we hit some kind of sustainability, where it wasn't just memes, it wasn't just the narrative, it was actually fees being generated, there was genuine activity, people were paying for services. And while I think that we hit our stride maybe just a little bit too late for this cycle, I think that we're in a position now where through the bear market, that kind of momentum has continued to grow. And so I think when we come into the next cycle and see a new bull market start, people are going to be looking around for what is working, what's sustainable, what's generating fees, and I think that will be DeFi again. So it's very possible that we kind of front run the cycle a little bit and really drive resurgence in the space.
I have 2 mics now. Let's see if this one works. So I think we speed ran in like 2.5 years through all of traditional finance's like 2,000 years. We had to figure out like what is base money, because we had UST and like random coins telling us that they were real money. We had Pool 2 tokens. That was like an interesting learning. People valued them very highly, and then they eventually realized that they're kind of getting farmed to zero. So like Kain said, a lot of the sustainability lessons that we had to speed run, hopefully we'll take into the new cycle, and I'm excited to bring a more sustainable version of DeFi.
I think one of the things that stood out the most to me in the bull run was really how the demographics of crypto have changed a lot, right? Now it's really, a lot of the people that are involved are involved to get rich, and that means they're really easy to scam, and that creates this whole the core of the whole dynamic of the bull run was just like scams upon scams upon scams, right? And Ponzi schemes and all this like complete hot air, which is, I was honestly surprised that when sort of the dust blew over, there was barely anything new that came out of the bull run, right? It was just like one giant lesson in, don't be too greedy. Basically, it's not going to work out for you, right? And the projects that remained were like the DeFi 1.0 projects, and of course there are a couple of new ones, but that was really like, totally not what I expected at the beginning of it, right? When you look at DeFi Summer, it was like, it's a whole new world, was the thinking, right? But I think everybody was like, we invented these primitives, like this ability to coordinate and organize, and then everyone was like, I'm going to use this to make some quick money, rather than build something lasting, right? And if you look at I think the more sort of OG protocols, they were actually trying to do real things, right? We were trying to build proper DAOs, proper governance, and it was just so difficult, and it was like a struggle, and it kind of looked bad in comparison to the main character types of like, we'll just do it centralized and spew some propaganda. But I think also, as Kain was saying, right now we're in the position where we've gone through these like hardships basically, and we can start trying to build some real stuff in this space with kind of the dust that remains after all the important lessons the space had to learn through that whole episode.
Yeah, I think for Maker in particular, sort of a good segue into the next topic. One of the sort of current metas in DeFi and in crypto overall is real-world assets, or RWAs, and that means a lot of different things, all the way from like tokenized real estate, which my eyes might glaze over if I get another like tokenized real estate pitch, to kind of what Maker is doing in terms of actually financing and real-world assets, and obviously a bunch of teams trying to do tokenized treasuries now. I'm curious, maybe starting with Rune, to get just a quick synopsis of what Maker is doing with respect to RWAs, and for the other panelists, how you guys think about RWAs with respect to your own projects.
Hi, Tom. We know you didn't mean to start without the women. We're here. Don't worry.
Oh, amazing, amazing.
Girls are here.
Just in time to get grilled. It's perfect.
So what we're doing in Maker is basically, literally, we're like 8 years old now in Maker. So like, I guess 7 years ago, we realized that the basic economics means you simply cannot, you can't scale one asset pegged to some particular external asset without backing it by other stuff that's also pegged to the same thing, basically. Like you can't scale up a stablecoin pegged to the US dollar unless you use collateral that has some connection to the US dollar as well. Otherwise, you basically, you end up with either having the peg break or the collateral break, which is something like what happened with Terra and Luna, right? So early on it was hard for us, right? Because the problem with real-world assets is they're not as decentralized as pure noble ETH or something like that, right? But it was clear that this is how you actually scale it up and how you make it sustainable. And it took so many years to figure out how do you make this connection between DeFi, which is one completely separate thing, and then the real world and regulation and banks and that have no clue what the hell we're doing. It took a long time. We finally managed to actually make that connection, and then basically what we're doing now is we essentially generate stable coins, convert them into cash, and then allocate that into treasuries and similar assets. And then we can pull it back out to basically keep the peg of DAO, essentially. So if people want to pull their money out, they can essentially tap into the real assets that the DAO is allocating. And so the key thing is all of this is ultimately run through what we call governance instructions, which means it is like DAO proposals and DAO decisions that are voted on, that it's sort of translated into actual legal instructions for the counterparties that they have to follow according to the whole legal structure set up. But it's very primitive in many ways. The important thing is it works and it's safe. The next step is absolutely tokenized assets, moving things on chain, getting things to move really fast and efficient. And then also just kind of the closest we get to decentralization of real assets, which is very, very good diversification across jurisdictions.
Kain, I think Synthetix has taken kind of a different approach. Curious to hear your thoughts.
Yeah, so I remember 2018, the first DeFi summit, sitting in the crowd heckling Rune about his plans to tokenize real-world assets, right? And I think, my confession, I guess, is that I really mid-curved it. Like, I was like, you can't tokenize real-world assets; they're not on-chain. The reality is, we didn't have the tools then, but I think the vision of finding a way to wrap these things in an approximation of permissionlessness and credible neutrality was really the game. And we didn't have the tools, and it wasn't clear how that was going to play out. But I think that we're getting much closer. And so I think, now I look at that and trying to do everything with purely on-chain assets is like ultra hard mode, right? And Synthetix has done this for a really long time. We've dabbled with certain things like allowing DAI into the protocol, and we've kind of started to get to a point where I think we're comfortable with some off-chain assets being included, but taking that really hardline stance of ETH or other permissionless assets only makes it really, really hard to scale. And so when I look at Maker and this kind of whole cycle of how they've gotten to this point, it's super impressive, because in my mind I was like, this is not going to be possible. You're not going to be able to do it at all. So I think the other advantage is now the real-world assets having such a good kind of inherent yield really creates the right incentive as well. When treasuries are paying out, the non-zero interest rates, then it makes it really worthwhile to work out how to do this. And Maker spent a long time doing that, and I think that they've kind of led the way. And hopefully, this is the nascent period, but I do think hopefully we will get to a point where we get much better at tokenizing all kinds of real-world assets, and that's going to unlock a ton. I mean, DeFi is not going to be real if it's this little sandbox that is cauterized from the rest of the world. It has to find a way to interface, and I think that working out that interface is one of the critical things. So, it's pretty impressive to watch.
Thanks. MC, I mean, Uniswap, largest decentralized exchange. Presumably there's some place for RWA within decentralized exchange. Curious to get your thoughts.
Yeah, sure. So I'm MC, I'm CEO of Uniswap Labs. So you're right, we're best known for being the original developers of the Uniswap protocol, largest decentralized exchange, 1.6 trillion supported to date. But we also build products on top of that, and really believe that amazing products for consumers and for professionals are critical to making this a better financial system. So to that end, I think actually this is kind of well-timed. This next chapter in DeFi is kind of well-timed. As you've said, yield has shifted to real-world assets. We don't see the same kind of on-chain yield. The question we've been asking is, what kind of infrastructure do you need to support other kinds of assets? We need more assets on chain, and the reality is that the trading market structure that we have today is kind of limited. So AMMs are innovative in the context of financial markets. They're uniquely enabled by blockchains, but they don't necessarily allow for some of the customization that you might need for different kinds of real-world assets. So you have a certain approach to that, and Uniswap's approach is Uniswap v4, which is essentially allowing customization at the liquidity pool level. So that means that if you need to have certain kinds of phased release of a token, you could have even circuit breakers that adjust for volatility. You could have all kinds of different customized approaches that might allow different kinds of assets to trade more easily on chain than they can today, when there's just kind of a little bit more of a one-size-fits-all approach. So more assets on chain, great. We're not doing anything to actively tokenize assets, but hoping to be at the forefront of building infrastructure that's a lot more flexible.
Very cool. Dovey, I think from an investor's perspective, how do you think about the investable parts of sort of this RWA stack, if there are any, in your perspective?
Yeah, so I think the real asset, this cycle, reminds me a lot about the STO from 2018, which was a meme, and also just back in the days when it comes to bit shares, because I was the early user of bit shares, and I think there's a lot of this experimental ideation around wrapping real-world asset. But I want to give a very interesting example is when I asked my younger brother, so he's a Gen Z, and he has been trading all the sneakers, right? Sneakers are real-world asset, and there's all these Asian marketplaces, and then just tracking the price of individual sneaker model. And when I was working at eBay, and there's also all these different platforms and trading, just tracking different price quotes. So I think the question for us is, as an investor, do we want, from user perspective, are they looking for price exposure, like to like the real world asset? And if it's just like price exposure, and then we can do Oracle, right? So like we can like probably in the future like decentralize Oracle, like have like multiple like data feeds. And I think that's the most high leverage play, like when it comes to price exposure to like real world asset. But if we want to bring on real world asset as like collateral and like as like a wrapper whatsoever, and then the question to me is, and are we actually introducing more like counterparty risk and then like more just like opaqueness like to the system? Because I'm very crypto native, and so I'm a little bit on the fence for that. So far, I think like RWA, so like T-bill, like say for instance, like bearer bond, so it's actually very decentralized. And then so in like TradFi, so you can actually sell bearer bond like to the non-US retail. So I think if we want to expose to like T-bill in like a bearer bond manner, so I think that's possibly like a opportunity out there, but like that's also macro interest environment dependent. I think at the end of the day, like DeFi is like a macro interest rate like arbitrage between the CeFi world and then also the on-chain world. So far we haven't made any investment yet, so in this area. So, but we're definitely actively talking with a few teams out there. Yeah.
Got it. Actually, if Jordi.
Yeah, actually, so I would love to talk about this because we had quite a big announcement yesterday related to RWAs. We're designing, a new DeFi ecosystem, and I think from a first principles perspective, I don't want to get too philosophical, like do we want to bring things on-chain, leave things off-chain? I want to focus on the user, create user products that are great to use, that I would want to use, that people want to like bring their financial lives on-chain and actually keep their savings and do their activity on-chain. And from a first principles perspective, if there's a 5% plus yield being, debasing your dollar, let's say, like whatever fiat currency you're denominating in, it doesn't really make sense to just waste that, especially if you're in it for a long term and you're multiple years. So at Mantle, we've been examining all the providers potentially of RWA yield. We're happy to work with multiple ones. Yesterday, we announced a huge partnership with Ondo. So Mantle has a very large treasury, and the DAO has approved an initial $60 million tranche to go towards these type of assets. And it's actually not for the treasury. We don't really care about getting 5% as much on our large treasury. It's more, there's a process by which we can actually give it to other users to use the same way that they use USDC, USDT. There's all this legal stuff that makes it possible. Basically, there's a 40-day holding period. But with a very large treasury, what we can do is do the marination ourselves. And then once the 40 days are up, users can actually just hold it in their wallet and get 5% yield, which I think is a game changer. Until now, RWAs have just been sitting in corporate treasuries that have KYC'd. So it's something I'm very excited about.
Very cool. MC, I wanted to go back to something you were talking about with respect to Uniswap Labs, developing these applications on top of Uniswap, the protocol. I think, in many ways, Uniswap was sort of at the forefront of this trend of teams having these sort of for-profit entities that are building applications, building products that are complementary to a core protocol, but separate, and sort of having the DAO and the protocol being governed separately. Rune, I feel like Maker is almost like the opposite side of the spectrum, sort of like DAO maxi, if I had to, kind of put a phrase on it. I'm curious to get both of your perspectives. How do you think about these two sort of different structures of these two different cap tables? Are they synergistic in some way, or like, walk me through a little bit how you think about Uniswap Labs versus Uniswap the protocol?
An amazing protocol that's going to be a critical utility, a core utility for a financial system, has to be used by many, many teams, and needs many teams that care deeply about its success and making it better and better. And so multiple for-profit companies that build on top of Uniswap protocol, I think, is the best answer for DeFi. So I don't really see it as like a choice, right? You're right. In the case of Uniswap, it happens that the team that Hayden Adams started with a grant, and then as Uniswap protocol took off, it doesn't need a team to continue to operate. It's autonomous, as probably everyone in this room knows, and hopefully you've all used it. It's autonomous, self-executing code. And so then you have an opportunity to say, well, what's going to drive the adoption of this primitive? And really, it's making it easier and simpler, and that means delivering the ability to swap any token for any token in a mobile app. That's why we launched a wallet. It means allowing off-chain liquidity providers to more easily provide liquidity to on-chain swappers. That's why we launched Uniswap X. So each of those are products that I think drive the overall success and development of Uniswap as a core protocol. And how I think about this broadly, just beyond Uniswap, is that part of the point of having core financial activities as interoperable code is that you get technology network effects. And to really have the power of those network effects, you need multiple teams that have a positive sum approach that are invested in that. So it's kind of like saying, SMTP exists, why should we have multiple email applications? That's a very simplistic, I think, analogy. But to me, it's really like the question of 2020 and the question of 2021. And instead, I'm really excited to see with Uniswap v4, for example, so it's being built in the open. There are a couple dozen different contributors who have no relation to Uniswap Labs, who we didn't solicit. They didn't even get a grant from the Uniswap Foundation. And there are now multiple companies being funded to build things on top of Uniswap v4. And I think that's the way we make DeFi really powerful, and not just an interest rate arbitrage, but actually a better financial system.
Rune, what about you? Is there going to be Maker Labs coming out soon? Are we going to get Maker Swap soon? Or how do you sort of think about entities versus DAOs?
So the big difference between Maker and Uniswap, which I am very envious of, is that Uniswap is, it's a DeFi protocol that's simple enough that it really is just like fully autonomous, right? It doesn't require ongoing adjustment of parameters to not explode. And most other DeFi protocols, especially the more advanced ones, they're not so lucky. So they require most cases, they require what I call big governance. And Maker is like furthest out on that spectrum, right? Because what Maker has to deliver is constant tail risk management, right? That's kind of the whole thing, is DAI doesn't randomly blow up because there actually is all these like economic mechanisms and all these companies and all these people sort of primarily focused on that one problem, right? But the problem is tail risk is sort of by its very nature. It's not, you can't really automate that into like a couple of smart contracts or something on chain like you can do with Uniswap just functioning. So what that means is not only do you have to sort of govern it under sort of the first order basis, right, of actually do this thing it's supposed to do, you also have to like watch the watchmen sort of. And then you get into this like big governance scenario where you really have to build up a massive system of checks and balances and governance dynamics and processes and even like political dynamics and yeah, all this good stuff that the Maker has had to deal with for the past 8 years. And so what we found is like absolutely our approach is you want to split it up. You don't want to have a single sort of big blob. You want to have many different companies, right? We have so many companies working for Maker. I can't even count them. I can't even, like 20, 30 or something, depending on what you count. And we're actually going a step further in that we realized you even want to take the DAO token itself and the DAO itself, and you want to split that up. And so that's this sub-DAO launch that we're doing, right? So we're basically taking Maker, we're splitting it up into smaller, more specialized DAOs. And it's the same basic idea of like you want to keep things smaller so it just doesn't get too complex. And so people can kind of focus kind of on their own specialization and then have a more kind of transparent and competitive environment between the different actors rather than like a big sort of structure that you then sort of, have to basically justify why it's decentralized, despite that ultimately it's hard to imagine that a big governance requiring protocol could survive if it primarily has just one company delivering everything and then suddenly that company goes away. Right? So that's really our main goal in how we view the Maker ecosystem is there cannot be like a single company or two or three or whatever that are required for the thing to survive.
Kain, I mean, you're one of the other big DeFi founders on this panel. Curious to hear how you're thinking about this.
Yeah, so we have a similar problem, right? In Synthetix, it's a complex system. It requires ongoing governance and maintenance, and not just parameterization, but development, right? Like we're about to launch V3. We're trying to launch on other chains. There's still like really unsolved questions in the kind of mechanism design of Synthetix that need to be managed, and someone needs to make decisions about that. So a long time, we started with a similar approach to Maker, where we had an open source software foundation, and then we had a sort of DAO on-chain component, we shut down the Open Source Software Foundation. We don't have any for-profit entities that are involved in the protocol anymore for a whole bunch of reasons. But the primary one was regulatory arbitrage. We were very confident that regulation was going to get much harsher. And unfortunately, that has played out. I wish I'd been wrong there, but I think the reality is probably worse than we expected. And so the idea that you could have any centralized party that had meaningful control over something like Synthetix was just not possible. And so we had to do that, and we pushed through that. And now we have a version of representative democracy. I'm not a big believer in direct token democracy. I think anyway, that's a longer topic to talk about. But we have representative democracy. We have councils, and as Rune is saying, the same things happened. We started off with one council that was like monolithic, that did everything, and then we're like, wait a second, there's people on this council that have no idea about treasury management, no idea about risk management, no idea about this, and so we started splitting things further and further out. Now we have 5 different councils that govern the protocol. But all of that, I think, is really about trying to create an environment where you can have this continuous development without having centralized control. And it's just a challenging problem, and we're still all kind of figuring it out. One of the things that's been interesting for me over the last few months is, as we've launched Infinex, which is a new front end that I'm building to build on top of the Synthetix protocol, we're able to take a lot of the governance failures that we had in Synthetix, because again, that's not a for-profit entity. It's going to be its own DAO, its own separate coordination mechanism, and we've been able to strip out some of the mistakes and kind of tweak it. So again, this is an ongoing process, and I think it's going to take probably many more years until we get to a point where it's stable.
I mean, Jordi, I think Mantle is in a similar kind of situation where you have some approaches to L2s like Base with Coinbase, where very tightly connected, very tightly branded together. Mantle, a little bit more arm's length from Bybit. How do you sort of think about that relationship between sort of the entity and the DAO and the L2?
Yeah, we talk about L2 wars, but what I'm realizing is there's 2 different wars going on, and they're completely different. One is more product-based L2s, so like Base, you mentioned, is a great example, a bit more US focused. I would say Mantle is more internationally focused, but in the same category. And then you have maybe the very ZK and the very Arbitrum tech-based L2 focus. And we're very interested to see who's going to make the best CK provers and let them kind of fight their tech battle, which they've been doing for many, many years, right? Like ZK Sync, all these guys have been doing it for many years. We're very interested to see who's going to get the best technology and adopt it, and not ultimately just focus on the user itself. Centralized exchanges, we saw with Solana and FTX, there's ways that can go very well in terms of bridging, but ultimately it's better to also keep things fully independent. So yeah, with Mantle, there's no direct association with Bybit, apart from, we have a lot of partners, and they're one of our partners. And I'm curious, when we talk about any kind of company having a labs and having a token, what I'm seeing as we invest in companies, and we have an ecosystem fund that is 100 million that we're kind of co-investing with VCs, some projects like to have some value go to the equity and some value go to the token. I'm curious what Dovey thinks about this as well. Generally, I feel like the token should be accruing the revenue, because otherwise, normal people don't have access. It's only VCs who are getting access to the equity. And if it's half goes there and half goes here, it sort of splits up the value. I don't know what you think, you guys.
Yeah, so I think when we invest in protocol, so there's a protocol business, there's product business, right? So I think the best analogy here is, if you build an open protocol, so it's basically you're running your own nation state, right? And so then what is the equity of the company? The equity of the company is the residual value of the company, right? So I think the analogy to make here is, okay, so the protocol gonna get the equity of the sovereign state, and then so gonna be distributed to all the citizens, and so with its own treasury department, blah, 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 and in a decentralized way, and then so that's how the protocol can accrue value over time, and the value coming from the GDP generation on top of that protocol economy. And the company I think like the company, so there's also state-owned company, right? So I think like the company in this context are gonna probably represent some of this like, state-owned companies' activity out there in that specific economy. So it can be building for tooling, building for infrastructure, like whatever services out there. So I think there's definitely a balance that the same team probably able to play. So definitely is super, super hard. So for me as an investor, and I would definitely prefer team to just pick a side. So you either build for protocol business or you build for product business. But I think because we are also very big backers for like GMX, and so what I have seen in like GMX is like the core team basically set up the protocol business, like a new sovereign state. And then so we have all these like anonymous team members like coming from like everywhere and then just like building on top of that. And then also similar to like Synthetix as well, like all the front end, like all the client side. And then so with like Uniswap, like now we have hooks. And then MetaMask, like yesterday just launched their snaps, right? And I think this like permissionless API, so permissionless API business, and then so to contribute to the permissionless economy, and so it's definitely what we crypto native investor that we want to see. Yeah.
Yeah. I think, Kain, you mentioned regulation and sort of thinking about regulatory arbitrage, and I think despite being on the opposite side of the world, we have to talk about US regulation a little bit. Some news coming out in the past week. There was a CFTC settlement with Open, DaraDex, and 0x. There was Treasury guidance coming out suggesting that things like wallets and UIs might be reclassified as brokers under US regulation. I'm curious how you all think about domiciling your team, serving US users, overall going forward, how you think about US regulation impacting how you choose to build product, how you choose to form your teams, things like that. Maybe MC, starting with you.
Yeah, I'm happy to start with that. So Uniswap Labs is based in the United States, and we have a physical office in New York City. And I'm always amazed how that blows people's mind. Look, I think that the details matter a lot. I think that it's easy to look at headlines and get really freaked out. So our team is based in New York. We're building software as we don't custody anybody's money. None of the activities that have caused sort of regulatory actions are things that we've engaged in. And so if we're going to build a financial system that's going to be part of the world's largest financial center in New York City, we think it behooves us to have a presence there. And so we don't see that as a problem. Our products, the wallet, the web app, are instantly global. And a fraction of the users are based in the United States. So of course, that's why I'm here. We're really focused on growing in Asia. We're focused on making sure that we internationalize our products, that they're not all in English, that the interfaces are mindful of the markets that they operate in, and that we're focused on markets where the consumer environment is a little bit more open-minded than what it is in the US right now. So look, it's going to be a challenging period, but if we're ultimately trying to build safer, more transparent, more accessible financial software, then it's worth pushing through, and that's no reason to leave the United States.
Rune, maybe curious to get your perspective as well. I mean, Maker is kind of as global as it comes. DAI is, what, 3-4 billion in size now. How do you sort of think about global presence and sort of serving global users?
Yeah, so I think it's a bit of a contradiction in a sense, right? That on one hand you've got Maker. We're building the biggest decentralized stablecoin, which means we are. I mean, in some ways we're like promoting dollar dominance, right? And on top of that, we're investing into the American economy, right? We're deploying billions of dollars into treasuries and the banking system. But when it comes to basically crypto regulation, I mean, our stance at this point is pretty much it's complicated enough already to be a DAO. So we've basically sort of through our governance made the decision to just like from all the sort of official front ends affected by the DAO, we block American IPs and block VPNs, and this is just what we think is this is like a, obviously it's a very complex problem, but this is a solution we think is like a decent solution in the sense that then we can focus on building and on delivering to users and not run afoul of some basically an uncertain environment. I mean, I wish it'll change, and I think it will. It should change. It's possible and this is kind of the way we see that we can contribute to it, right? It's possible the way the change happens is we go out in the world and we make some really, really good examples of what are the advantages of properly embracing crypto. Right now, what I'm seeing is South Korea and Japan are two countries that are, I mean, on one hand, they're sort of careful and slow moving and have their various, have had the various issues with crypto, but they have this like sort of enduring positive stance towards innovation. That means that they're very careful about how they roll out the regulation, and they're very, very interested in capturing the benefits. And that's the kind of places where in Maker, that's what we want to focus on and build that up as like a positive story. And then it's just, I mean, you gotta get with the times if you want to be competitive, right? Again, America is in such a weird position because it's the global financial center and it has the US dollar and so on. But even in that case, I mean, sooner or later, I think sanity should prevail.
Yeah. Dovey, how do you think about underwriting regulatory risk as an investor?
Yeah, so first of all, I think it's pretty lazy for all the governments. And so first they outsource the monetary policy to like US government, and now they outsource their like regulatory understanding to like US government. So I think there will be competent government like coming up, and then so no matter South Korea, Singapore, Japan, and then so we have seen a lot of things like happening in like Dubai right now. So it's definitely such a negative for like the US as like a talent pool, because what I have seen is that 2021, and I have 2 US founders, and basically on the process of like so just like giving up their like US passport, and like 2022, and I have like 4 US founders, and just like on the process of just like cutting like the US tie. So I think you as a founder, so I've been telling all my founders, try to regulatory arbitrage like as much as you can, and then so if you cannot arbitrage anymore, sanction US before US sanction you. And then so like, that's why we are very deep into the anonymous founder space, because I think that is the only way that you have to become a ghost. So like, that's why when the sovereign power like tries to punch you, so they will punch you into the air. And I think like we just need to wait for long enough and for the US empire potentially just like degrade and like deteriorate, and some other sovereign power gonna rise up. And then so like, that is my true belief, like, to be honest, because if you look at all the empire in the history, and then so they always have a life cycle, and then so we have to exit from the top. So like, that's why that's my calling to all the US founders, and if you can exit from the top, and then so try to do it, yeah.
Let me add something. I think it's very different if you're starting something right now at this moment in time where you want to do that for maximum flexibility, versus if you're like Uniswap Labs and you have a product that's used that achieves the principles that regulators try to, right? And then the onus is on us to explain what we do, to explain that the biggest problem for consumers in crypto is FTX, and that self-custody there's a response to that, right? So I think the answer is very different if you're starting something today versus not. And the other point that you mentioned I think is important is that financial regulation is starting to kind of fragment and decouple around the world as a result of the US's now outlier harsh stance on crypto. And as an American, I think that's sad and unfortunate, but it's good for the industry to have a little bit more competition so that there's more deep thinking around what kinds of rules and regulations should take place. And the response, in the past few months, I've been in Paris, the United Kingdom, Hong Kong, and the response is very much, we want DeFi here, we love DeFi in different shades, and it's in stark contrast to the US. So globally, I'm pretty optimistic, and hopefully it doesn't take a decade or 2 decades for the United States global empire to crumble for DeFi to be adopted in the US.
I think that's probably a good light note to end on versus the empire crumbling. So thank you to all the panelists. Really enjoyed the answers, really enjoyed the discussion, and looking forward to the rest of the conference.
Thank you.